Something just happened inside the global financial system, not the crypto market, and almost everyone missed it. While retail investors were watching red candles and reacting to short-term price action, a signal just came out from the core of traditional finance that changes how XRP should be valued entirely. This isn't hype, it's not speculation, and it's definitely not priced in, because for the first time, the system that decides where trillions of dollars flow just acknowledged Ripple in its own language. And if you understand what that actually means, you're about to see this entire market very differently. Something changed inside the global credit system this week, and almost nobody in crypto is talking about it the right way. While the entire market was watching prices fall and timelines collapse, a global credit rating agency quietly handed Ripple something that most blockchain companies may never receive in their lifetime: an investment-grade issuer rating, BBB. The same class of rating used to evaluate the creditworthiness of some of the largest financial institutions on the planet. Let me be clear, this is not a press release. This is not a partnership announcement. This is an independent third-party institution telling the global financial system Ripple is built to last. And yet, if you pull up social media right now, most of the conversation is still about price. That is the gap between the crowd and the informed. And today, we're going to close that gap. Welcome back to Ledger.Wealth.Network. We are not here to hype you up. We are not here to sell you a dream. We are here to decode what is actually happening inside the financial architecture being built around XRP, the developments that don't trend, the signals that don't get retweeted, and the math that most retail investors never sit down to run. Let's get into it. Let's start with the hard truth. 90% of people watching crypto right now are measuring the wrong thing. They're watching the price ticker. They're watching the chart. They're watching what XRP did in the last 24 hours. And because of that, they are completely blind to the structural transformation happening underneath. Here's the concept you need to understand: credit infrastructure legitimacy. In traditional finance, the world of sovereign bonds, institutional custody, and multi-billion-dollar capital deployment, nothing moves without ratings. When a pension fund considers exposure to an asset class, when a sovereign wealth fund evaluates a counterparty, when a global bank decides which settlement rails to integrate, they do not look at a white paper. They look at ratings. They look at institutional credibility signals. They look at frameworks that have been stress-tested over decades. Ripple just entered that framework. A BBB investment-grade issuer rating from an internationally recognized credit rating agency is not given out because a company has a good roadmap. It is given because the agency has evaluated cash flows, business model durability, operational discipline, and long-term viability, and concluded that this organization meets the standard. Think about what that means in practical terms. Ripple is now credentialed in the language that institutional capital speaks. That is not a crypto milestone. That is a financial system milestone. And here is where most people get the sequence wrong. They think adoption drives ratings. But the reality is the opposite. At scale, ratings drive adoption. Once a counterparty carries investment-grade credibility, conversations that were previously impossible become routine. Integration pipelines that were on hold get activated. Capital that was sitting on the sideline because of counterparty risk concerns starts to move. David Schwartz and Brad Garlinghouse have been consistent for years. Ripple's goal was never to be the loudest project in the room. It was to become the most trusted infrastructure layer in global payments. This rating is the clearest signal yet that the strategy is working. And if you understand that, then everything else happening right now, the regulatory debates, the macro pullback, the noise, reads completely differently. Let's do the math. Because this is where the conversation gets serious. The global cross-border payment market moves approximately $150 trillion annually. That is not a guess. That is a figure tracked by the Bank for International Settlements. $150 trillion moving between institutions across borders every single year. Now here's the problem the existing system has. To facilitate those transactions, financial institutions park capital in what are called nostro and vostro accounts, essentially pre-funded liquidity pools sitting dormant in foreign currencies waiting to be used. The estimated value of capital tied up in those accounts? roughly $27 trillion globally. $27 trillion. Locked, idle, earning nothing, sitting there as friction in a system that desperately needs to move faster. XRP was designed to solve exactly that problem. Instead of pre-funding accounts in every currency corridor, you convert to XRP, move it across the ledger in 3 to 5 seconds, convert to the destination currency on the other side. The capital is freed, the friction disappears. Now here's the math that the retail crowd ignores. If XRP captures even 2% of the liquidity efficiency market in cross-border settlement, a conservative, almost dismissive number by any institutional standard, you are talking about access to trillions in transaction flow running through a fixed supply of 100 billion tokens, roughly 55 billion of which are currently in active circulation. Think about that. Fixed cap, growing demand, shrinking exchange reserves. On-chain data from CryptoQuant has shown exchange holdings trending toward multi-year lows. That is not random. That is accumulation behavior. Tokens moving off exchanges don't come back quickly. They go into custody, into enterprise wallets, into ODL pipelines. And here's the piece that reframes everything. At higher price levels, XRP becomes more efficient as a bridge asset, not less. Higher price means fewer tokens are needed to move the same dollar value, less slippage, less market impact. That means the system has a built-in economic incentive for price appreciation over time as utility scales. This isn't a prediction, it's a requirement. The math doesn't lie and the system is almost complete. While retail investors were reacting to red candles this week, let's talk about what the institutional layer was actually doing. Ask yourself this brutal question. Does a global credit rating agency issue an investment-grade rating to a blockchain company during a bear market pullback if that company's future is uncertain? Absolutely not. These agencies exist precisely because they cannot afford to be wrong. Their entire business model depends on the accuracy of their assessments. When they move, they have already done the forensic work that most retail investors never will, and they are not the only ones moving. Ripple's acquisition of Hidden Road, one of the largest prime brokers in the digital asset space, connected their infrastructure directly to over 300 institutional counterparties. Think about that network, 300 institutions. Not retail traders, not crypto enthusiasts, but banks, funds, and financial infrastructure firms now sitting inside Ripple's ecosystem. Then add the acquisition of Standard Custody, which gave Ripple regulated custody infrastructure. Then add the continued rollout of the XRP Ledger's automated market maker functionality. Then add the growing pipeline from Enterprise Treasury Solutions. Franklin Templeton, one of the world's largest asset managers with over $1.5 trillion under management, has already tokenized funds on public blockchains. The infrastructure question for them is not if, it is which rails. BlackRock has made its position on tokenized assets unambiguous. Larry Fink has stated publicly that tokenization is the next generation of markets. These are not crypto believers. These are capital allocators, and they do not position without legal certainty, custodial confidence, and counterparty credibility. Ripple now checks all 3 boxes. While the crowd is panic selling because the chart looks uncomfortable, the silent architects of the next financial system are signing infrastructure agreements, finalizing custodial arrangements, and preparing deployment frameworks for the moment regulatory clarity arrives. This isn't retail FOMO, this is calculated positioning by institutions that know exactly where this is going. Now let's talk about the catalyst that ties all of this together. The Digital Asset Market Clarity Act has been in development longer than most people expected. That frustration is understandable. But here is what you have to understand about regulatory timelines. The delay is not a signal of failure. It is a signal of complexity. You are not drafting rules for a single token. You are rewriting the jurisdictional framework for an entirely new asset class, one that sits at the intersection of securities law, commodities regulation, banking oversight, and international monetary policy. That takes time, and it should. But here is what's different right now. The political environment has shifted. There is active bipartisan recognition in Washington that the United States risks falling behind if clarity does not arrive. Other jurisdictions, Japan's FSA, the EU's MICA framework, Singapore's MAS, have already moved. The pressure is real. When the Clarity Act reaches finalization, the risk premium that has kept institutional capital cautious evaporates overnight. Companies that Jake Claver and other analysts in this space have tracked, entities that are already holding XRP in anticipation of that moment, will be in a position to deploy at scale immediately. The window is not infinite. The door is closing fast for the pre-clarity accumulation phase. Once the rules are written and the institutions activate, the positioning phase ends, and those who waited for the obvious moment will find that the obvious moment has already passed. The fuse is lit. The countdown is not measured in years anymore. Let's talk about supply, because this is the part of the conversation most people skip over, and it is the part that matters most. 100 billion XRP fixed. No inflation, no unlimited minting, no monetary policy committee that can vote to dilute the supply when the system needs a bailout. Of that 100 billion, approximately 55 billion are in active circulation. The rest sits in Ripple's escrow, releasing 1 billion per month. And historically, the vast majority of those released tokens are relocked immediately. The actual net increase to circulating supply is a fraction of what that number suggests. Meanwhile, exchange reserve data from on-chain forensic analysts shows a consistent and sustained drain. Tokens are leaving exchanges. They are not coming back at the same rate. That is accumulation. That is the behavior of entities that are not planning to sell in the next news cycle. Now layer on this, every new financial institution that integrates ODL, every enterprise treasury that adopts XRP as a liquidity tool, every tokenized payment corridor that comes online, each one increases demand against a supply that cannot expand. The signal is clear, but only for those who are actually looking. So let's pull this together. Ripple has just received an investment-grade credit rating, a signal that the traditional financial world is recognizing what this infrastructure is capable of. Exchange reserves are at multi-year lows. Institutional acquisitions have expanded Ripple's reach to hundreds of financial counterparties. The Clarity Act is moving through a regulatory environment that no longer has the luxury of indefinite delay. And the math of a fixed supply, utility-driven asset sitting at the intersection of a $150 trillion market has never been more compelling. The market is down, headlines are negative, sentiment is uncertain, and that is exactly where the most important positioning in any cycle happens. Not at the top, when everything is obvious. Not after the announcement, when everyone is already in. Here, now, in the uncertainty. The crowd is asking, why is the price down? The informed are asking, has anything fundamentally changed? And the answer, if you have been paying attention today, is no. The fundamentals have not changed. They have strengthened. Stay rational, stay patient, ignore the noise, focus on the architecture. In a market fueled by emotion and noise, we thrive on data and composure. Knowledge is the only hedge. Comment Ledger below if you made it to the end. I want to see who is actually paying attention. And if this kind of deep, data-driven analysis is what you come here for, make sure you are subscribed, because the next development in this story is going to move fast. Stay sharp, stay positioned. I'll see you in the next one.